So, if you've been paying any attention to money in Kenya this year, you've probably noticed a huge shift in the conversation. While all the traditional, safe places to put your savings are kind of struggling, the Nairobi Securities Exchange has been on an absolutely incredible tear. Today, we're going to break it all down: what's happening, who the biggest winners are, and most importantly, how you can start to figure out this exciting, dynamic market. We've got a lot to get through. We'll start with the big picture of this market surge, then we'll get into the specifics, the star performers. After that, we'll talk about what blue chip even means and tackle the super important topic of risk. And we'll finish up by showing you just how easy it is to get started these days and, how to think about building your own strategy. All right, let's dive right in. First up, the big picture. To really get why everyone's talking about the Nairobi Securities Exchange this year, we got to zoom out a little and see what's actually driving all this excitement. I mean, this is the question on everybody's mind, right? For years, things like money market funds, government bonds, they felt like the smart, safe, reliable places to grow your money. But this year, that whole story has changed. And this is where it gets really interesting. Just look at the contrast here. On one hand, you've got those old reliable savings options, and their returns are dipping. But on the other side, you have the Nairobi All-Share Index, the NSE, which has posted a staggering, almost unbelievable 44.83% gains so far this year. That kind of performance makes everyone sit up and pay attention. So, who's behind all this crazy growth? Let's zoom in a bit and look at the specific companies, the stocks that have delivered just mind-blowing returns to their investors this year. Okay, just take a second. Let that number sink in. Over 440%. No, that's not a typo. It's the real, actual growth one single company on the NSE delivered to its investors between January and August of 2025. It's absolutely phenomenal. And this is what that actually looks like in your pocket. The company behind that massive surge is Samir Africa. Their stocks just took off like a rocket after they successfully switched from making tires to leasing out their huge real estate holdings. Just think about it, putting in 100,000 shillings at the start of the year, and now it's worth over $500,000. Incredible. But hey, Samir Africa wasn't some kind of one-hit wonder. As you can see here, 4 other companies, including the NSE itself and Kenya Power, all more than doubled in investors' money in just 8 months. We're talking about life-changing returns here. But listen, investing isn't always about chasing these explosive, high-growth stocks. It's also about stability. So let's talk about the big, established players, the so-called blue chips, and see how they fit into this whole picture. So first off, what even is a blue chip stock? Well, think of a company that's a total household name. They're huge, they're financially solid, they've been around forever, and they often share their profits with investors through payments called dividends. They're basically the bedrock of the entire market. And here in Kenya, we have some real titans. Safaricom, the force that dominates telecommunications, East African Breweries, the leader in its market, and of course the banking giants like KCB and Equity Group. These are the kinds of companies that make up the core of so many long-term investment portfolios because they're just so stable and dominant. Okay, now it is time for a serious reality check. Because for every incredible story of growth we just talked about, there's another side to the coin. With the potential for huge rewards comes the undeniable, unavoidable reality of risk. This right here is probably the most important rule in all of investing. I really want you to let this sink in. Unlike a savings account, the money you put into the stock market is not guaranteed. It can go down just as fast or even faster than it can go up. And 2025 gives us some pretty stark examples. While all those investors in Samir Africa were celebrating, people who put their money into other companies like Umeme Limited or Limuru Tea were staring at some pretty significant losses over that same period. To put that into real-world terms, if you invested 100,000 shillings in Umeme at the start of the year, by August, you'd have less than 57,000 shillings left. It's a powerful, powerful reminder of why understanding and managing risk is just absolutely essential. Okay, after that dose of cold, hard reality, let's talk about some genuinely fantastic news. Because despite all those risks, getting started as an investor on the Nairobi Securities Exchange has never, ever been easier for the average person. Seriously. This right here, this is a complete and total game changer. See, it used to be that you had to buy stocks in big blocks of 100, which, could be a massive financial barrier.
Not anymore. Thanks to the one share minimum rule, if a share costs 400 bob, you can start with just 400 bob. The door has been kicked wide open.
And the real power of this rule is that it makes diversification super easy. Instead of putting all your cash into just one company and hoping for the best, you can now take a small amount of money and spread it across many different stocks in totally different industries. And that is your number one defense against the risk of any single company doing poorly.
So you're ready to get started. The barriers to entry are lower than they've ever been. But now comes the million-shilling question. How do you actually decide which companies to invest in? And let me tell you, it is not about getting lucky.
Successful investing is really part science, part homework. There are a few key things to look at. First, the fundamentals. Is the company actually making money? Does it have good leadership? Second, valuation. Is the stock price fair? A simple tool for this is the price to earnings or PE ratio, which helps you see if you might be overpaying. Third, industry trends. Is the company's whole sector growing? And finally, the dividend history. Does this company have a good track record of sharing its profits directly with you, the shareholder?
Ultimately, your strategy really just boils down to what you're trying to do. Are you a growth investor, hunting for the next Sammy or Africa, hoping for those big capital gains as the share price goes to the moon? Or are you an income investor, looking for those stable, blue-chip companies that will pay you a steady stream of dividends, almost like getting rent? There's no right answer here, only what's right for you and your goals.
Look, the performance of the NSE in 2025 has been nothing short of remarkable, and all these new rules have made it accessible to everyone. The potential is undeniable, but so are the risks. The opportunity is finally here for everyone. But the knowledge, the strategy, and that final decision, well, that now rests with you. So what's your move going to be?